In this video, we're going to go over a policy known as the Earned Income Tax Credit. We're going to give an overview, cover its strengths, cover its weaknesses, and then talk about reform. This content comes from a Tax Foundation article called Earned Income Tax Credit, a primer. Okay, so first thing, what is Earned Income Tax Credit? The Earned Income Tax Credit is used to offset income and payroll taxes for low-income workers. It was enacted in 1975, and it's undergone several changes over the years, and it's become a major tax expenditure and anti-poverty policy in the United States. These two main purposes, promoting work and reducing poverty, happen because it is a policy that is only available to the employed. The EITC is pretty complicated, and that will play a factor in some of how we think about the issue. But basically, the EITC is a fixed % of earned income up to a maximum credit amount. So it's a tax credit. And obviously, in this class, we've covered a lot about taxation, so we understand what tax credits are. So it's important to understand this varies. So the value of the credit varies, of course, principally by income, but also by your various taxing statuses, your number of children, your marital status, etc. It is received when you file taxes, and the important part, or maybe one of the most interesting differentiators, is that it is refundable. So if this credit makes a taxpayer's liability negative, pushes it below zero, that filer can actually receive the remaining credit as a refund. So not only does it lower a qualifying individual's tax liability, but any tax credit they get because of it is paid out, in cash, essentially. In fact, most households receive their earned income tax credit as a refund. In 2016, 27 million tax returns claimed to the EITC for a total of 66, almost 67 billion in payouts, 57 of which came in refunds. Okay, there are 3 phases to the earned income tax credit. Of course, these vary, and that's what this graph is showing here, depending on whether you have children or no children, whether you're married or not married. So we can see the structure is very different. But in general, in the first phase, this sort of climbing phase, right, it's shorter and flatter in different situations. This is where each dollar of earned income receives federal matching credit. The implication of this is that it lowers your marginal tax rate, lowers our marginal tax rate. The second phase, your additional earned income has no effect on the tax size credit. That's where we get these plateaus. And so the marginal tax rate for those filers doesn't end up changing. In the third and final phase, each additional income reduces the credit. That's where we get this downward sloping part. And this, of course, quickly raises the marginal tax rate back up towards what non-EITC filers are getting. Okay, the phase in, first phase, creates a negative marginal tax rate, while the phase out creates a marginal tax rate spike. Just really quickly to kind of put some numbers, it's the same information as above, but just so you can kind of visualize, here's a table showing what this was in 2019. So it just gives us a quick look at your income to your maximum credit when you start the phase out. This is probably the most interesting, right? Because this is when that third phase starts. And then, of course, you can compare what happens if you have no children and you're single, what happens if you're no children but you're married, what if you have, say, 2 children. It phases out at 19 versus phasing out at almost 25. Okay, figure 2, just kind of give a sense of what the EITC has looked like over the years. Just like we said before, we got to almost $70 billion at around that 2015-2016 mark. But, it started down in the single digits of billions back in 1975 when it was started. EITC has several strengths, one of which is that it is well targeted toward low-end workers. Virtually all the benefits go to those that are in low income, and by this we mean under $50,000 In fact, 86% of benefits go to people under 30,000. That's what this shows here. So you'll see those are the two biggest, and that's sort of the breakover between $30,000 in income a year and above. It also sort of does this by applying in rural areas, right? So we typically see EITC in some of our most rural and highest poverty regions. So down here in South Texas, the Mississippi Delta, some of our places in the Deep South, and then actually lots of area in the Dakotas are some notable low-income places that also have the highest in EITC. This is important. Sometimes you see maps that look like this, and they're essentially just heat maps, right? And so we see we've got New York, lights up, and Los Angeles lights up, and maybe even like Dallas or Chicago, right? And it's really just like a population map based on earned income tax credit. But this is an average, which sort of helps us actually understand what's happening here. Oh, before I leave that, it has some fairly good statistics. For example, in 2016, brought almost 6 million people out of poverty. And this is a study, so it's hard to know exactly how this works out. This is not just a number you know from the Census Bureau. It's a study by some economists, and 3 million of which were children. So if you believe those studies, and I'm not super well versed in this literature, but if you believe those studies, then it seems to have been pretty effective at fighting poverty. The other thing, and really what we're going to spend a lot of time talking about anytime we talk about the EITC, is that it encourages workforce participation, especially among single mothers. It doesn't increase hours worked, it just increases workforce participation, so people being in the labor force, but it's not strong among other workers. So one of the problems with welfare programs and other types of anti-poverty programs is they often cause workers to have less incentive to work, and that's something that we want to avoid, and that's where the natural shape of the earned income tax credit is really important for encouraging workforce participation. Okay, let's turn to the weaknesses. The first thing is that it's a high level of complexity, which causes error rate between a quarter and a third of filers end up making mistakes when they're trying to apply for EITC, getting improper payments or not getting payments at all. So here's just a list of requirements you have to satisfy in order to get earned income tax credit. You have to file federal income tax yourself, right? So if you have married individuals, you have to file. As the dependent, you can't get EITC, right? So you have to make those kind of decisions. You have to have earned income, right? Which is one of the strengths, but it also does every requirement raises the complexity of the policy. Third, you have to meet residency requirements. These, of course, are very naturally going to end up causing people problems when they move, or they have driver license in one place and addresses in others, things like that. And of course, the children that are being claimed as a part of EITC, they have to meet these relationship and residency and age requirements to be considered qualifying, and that's naturally going to cause problems depending on what the children's status are for these things. If you don't have children, then you have to be between 25 and 64, right? If you do have children, these don't apply. And then tax filers' investment income has to be below a certain point, right? So just because you make low income from your work, but you make high income from investment, you're not necessarily eligible for earned income tax credit. And then, of course, you can't have committed fraud or something like this that would disqualify you from receiving it. And then, of course, you have to have all the Social Security numbers for everybody that you're filing for. Those of you that have children know that this is a significant cost. Another, before I turn from that, the three most common errors are incorrectly claiming children, misreporting income, and getting the wrong filing status. Pretty understandable. So we got an error rate that's typically between 25 and 30% because of these. Now, EITC encourages workforce participation, but it also actually has some work disincentives. This is because it encourages work in phase 1, but actually discourages work in phase 3 because the marginal tax rate goes up. Just as we've discussed elsewhere in this class, when you raise the tax on something, you are disincentivizing it. Even if you've lowered it and then raised it back up, this still works. Now, as we've seen throughout the class, we really are going to want to think about how it is that income and substitution effects are at play anytime we have changes in prices, right? So the substitution effect, right, is you have increased value for working, and therefore you have an increased, notice that we're looking at hours here, you have an increased incentive to work more hours, right? But your income effect, it boosts income. It actually allows workers to reach a certain level of consumption while working fewer hours, thus creating an incentive to reduce the number of hours. Therefore, this is an empirical question, right? Which of these things outweighs the other? And we're not going to be able to know direction and certainly not magnitude just from theory. Another weakness is the marriage penalty, right? Filing jointly greatly reduces the speed at which you reach the phase out, right? So if you have a couple and they filed jointly, their total tax bill will be greater than when they filed individually. So adding a partner's income to the other can push the couple's combined income into the phase out range, reducing the couple's combined after-tax income. So this penalty is possible because the EITC is based on household income, unlike other types of policies. The main thing that EITC gets compared to is minimum wage. EITC is a much, much better policy because of the strengths that we discussed earlier and the relative lack of impact from its weaknesses than minimum wage. So if you're a fan of minimum wage because of the things that you think it achieves, earned income tax credit is typically a better version of that. Okay. Of course, in the same way that we have problems with a marriage penalty, there's a disparity for people that do and don't have children, right? The EITC benefits workers with children far more than it does without, creating a family status differential. Might be a little weird to call these weaknesses when this is sort of the policy's target, right? But how those disparities play out in decision making is going to matter, and so it's definitely at least a potential weakness of the policy. So here's a quick look, right? So a look at childless workers receiving a smaller average earned income tax credit. Again, does it make sense that this is almost 10 times as large as that? My guess is people without children will say yes, and people without children will say no, and people with children will say yes. But it's worth pointing out and talking about, right? So we see the same kind of figures here where, we have this sort of growth between no children up to having 2 children. Of course, it falls back off over time too, which is another thing that we could talk about. Okay. Finally, I want to talk about reform. There's one really obvious one is to just simplify the rules, right? You've got complicated requirements that cause lots of errors. But, you could fix this if you just simplify the rules. Say, for example, you change the rules so that if you have filers living with a qualifying child but don't claim the child, then they could claim a childless ETC, something like that would help. Eliminate the marriage penalty and expand benefits for the childless. These would sort of flatten the policy. So depends on how you view those potential weaknesses. In conclusion, EITC is an important but flawed policy. You got some strengths of the policy. It's targeted toward low-income workers, counters regressivity in the tax code. I would say instances of. It's not really principally error, right? And encourages workforce participation among some groups. On the other hand, it's complicated, causes errors, can actually create negative incentives at certain margins. It probably just raises where those margins are relative to other policies. My upshot of this policy would be it's not great, but it's the best that we have.